Okay, we are recording. Hi there, everybody. Good morning. I am doing this recorded lecture for chapter 7 of our textbook. And in chapter 7, we get to budgeting. So we're going to look at pieces of the master budget, those individual budgets that make up the master budget, and then also look at a flexible budget together. So we're going to get obviously some practice with this in class together. And so I'm going to share my screen with you and get the PowerPoints pulled up. And I will post these into OwlNet once I am done, once I'm finished with this recorded lecture. So I did have to use some PowerPoint slides from another accounting textbook because the PowerPoints that came with this textbook did not have any examples of the individual budgets. So I actually stole some PowerPoints from another accounting textbook that I've used in the past to give us some idea. But within the pages of the textbook, they do show examples. The book just didn't give PowerPoint slides for those examples. But nonetheless, it'll show, kind of show us and give us an idea of what these budgets look like and how they're prepared. And a lot of them, the majority of them are not too bad. There's some of them that get a little bit complicated, but nonetheless, we'll be getting practice with it together. So some of our learning objectives we're looking at, explaining the general principles involved with budgeting, identify preparing the components of the master budget. So those components are, for example, the sales budget, the materials budget, the labor budget, the overhead budget, those types of production budgets, selling and administrative expense budget, cash budget, right? So there's several different components that make up the master budget. And then identify and prepare components of the flexible budget. Again, we'll see examples of this. Kind of the main difference between the master budget and the flexible budget, again, as we'll see as we continue through the slides, the master budget is prepared in advance, generally speaking, in advance to the start of the accounting year, right? So at the company that I used to work for, we were on a fiscal year, July 1 through June 30th is the way our fiscal year was set up. And we started the budgeting process like in February. And so what would happen is the accounting department would give each department, because each department head has to prepare, their own budget, right? So Becky, the conference department manager, had to prepare her own budget, and the IT manager had to prepare his own IT department budget, and membership had to prepare their own budget, so on and so forth, right? So accounting would distribute the budgets to each department. They would fill out the information in Excel. All the budgets were prepared in Excel. We used Microsoft Dynamics accounting software, and that is compatible with other Microsoft products like Excel and things like that. So we would prepare them in Excel and then upload them or sync them basically with our Microsoft Dynamics accounting software. But so each department head would receive their budget, they would fill it out, they would turn back into the accounting department, we would compile it into a master budget, right? So that process was usually finished by, late April, or early May, and then completely finalized, by the start of the fiscal year, July 1, right? Whereas a flexible budget, so master budget prepared in advance, right? A flexible budget, just like it tells us in our book, is prepared after the fact to compare our budgeted data, our standard cost, to what actually happens. So again, we'll see examples of that. And then also we'll talk about how overhead is calculated depending on the type of capacity or manufacturing capacity that is used in the calculation. All right, so again, like we mentioned on the previous slide, the master budget is prepared prior to the beginning of the accounting period. It's based on the company's planned objectives or what they want to accomplish. Flexible budget is prepared after the fact to compare the actual operating results to what was budgeted, right? So just like it shows here, most companies will use some type of budget, and it's a good way, even in our personal lives. If we use a budget, it's a good way to kind of stay on track and outline, what you want to happen, set those objectives, right? And it lets us or allows us to develop a plan and then to know each month, for example, how close we are to that plan, if maybe we're going over budget on something or under budget or whatever the case may be, we can compare what actually happened to what was budgeted, right? So that's kind of the main purpose of it. And we get into that when we look at the production, the flexible budget performance report. And then also we get into that a little bit more. And I was just trying to double check here on the table of contents. Yeah, we get into that a little bit more in chapter 8 as well when we look at standard costing and variance analysis. All right, so some of the benefits of budgeting. You guys have a multiple choice question on your final exam. We need to know, I think the question is set up like something to the effect of, all of the following are benefits of budgeting except, right? So if we know these benefits of budgeting, then we should know which one is not, right? So again, developing a budget helps coordinate all activities of each subunit of the company or each department within the company. Helps to communicate the plans throughout the organization, helps employees and departments work toward the company's overall goals. It can be a form of motivation, especially if an employee is paid like, bonuses for hitting a certain budget or, sales commissions, things like that, right? Then they're usually pretty focused on exceeding those budgeted numbers. Focuses on future opportunities and again provides a benchmark for evaluating performance. So at the end of every month, again, the company that I used to work for, at the end of every month, when we prepared our financial statements, we also, in that report, printed up the budgeted data. So, along with printing the income statement, right, it would also print up what was budgeted for that month. And then it would look at side by side actual versus budgeted data. To see where we were at. So, every month we could look for, abnormal variances or large variances or differences between actual data and what was budgeted, or actual results and what was budgeted, to determine if any changes need to be made or if any adjustments need to be made, right? All right, so some of the principles of budgeting or good budgeting practices. Obviously, we want to clearly define our objectives. These need to be realistic and attainable, right? We must also, consider not only internal factors, but external factors. Like, for example, if we use, some type of raw material in our production process, the price could be, potentially going up because of, political decisions or the political environment. That's something that we would need to consider, right? Or, again, maybe if we are a company that travels a lot or uses a lot of fuel, maybe we're a transportation company, something like that. We use a lot of fuel. We have to consider, not only internal factors that impact our budget, but then all like our, what we expect to sell or what we expect to transport, right? We not only have to consider those internal factors, but then we also have to consider, external factors that may come into play with rising gas prices, or legislative action to reduce fossil fuel usage, or whatever the case may be, right? We have to consider those internal and external factors. So generally speaking, historical data is kind of the starting point, and then we might go up a little bit each year. So I know on some of the like we used to do at the company I work for, we did conferences where we brought together, electrical manufacturers and electrical distributors, right? So manufacturers and distributors would come both, they'd come to the conference. It'd be a networking opportunity for them and stuff. And so when we're working on our conference department budget, we would use, okay, well, what happened last year? How many registration seats or tickets or whatever you want to say were sold last year? And then we might up it, 5% or whatever. Or, in the current kind of environment we're in, maybe we would decrease it, 25% or whatever, right? So we have to kind of make those decisions as we're preparing it. Again, the variance analysis, this is when we're comparing actual results or actual data to what was budgeted. So we're looking at, for example, with our sales, what did we budget? What actually happened? With our costs, what did we budget? What actually happened? We're calculating a difference or a variance. The budget must be flexible enough so that it can be modified. Again, we're going to look at a flexible budget. As long as we have our variable cost broke down per unit, and we have determined our fixed cost, we can pretty much prepare our budget for any level of activity, right? And then responsibility accounting, this is as it relates to, there has to be, a clear kind of chain of command of who is responsible for a budget and who that person reports to, essentially. And this is where it comes into play, just determining on different, or depending on different departments, like a manager of a factory department or a production department. They're only going to be in control or responsible for the cost incurred and controlling those costs in his or her department. They're not going to be held accountable or be held responsible for cost incurred in another department they have nothing to do with, for example. So this responsibility accounting just, again, says that there has to be kind of a clear chain of command, and who is responsible for these costs and who is held accountable for the actual data as it relates to, the variance analysis with the budgeted data. All right, so preparing the master budget. Again, the master budget, this is what's known as a static budget or a fixed budget. It's prepared for just a single level of activity or one volume of activity. And we can kind of see how this master budget is broken down into these individual budgets. So under operating budgets, sales budgets, cost of goods sold budget, production budget, direct material, direct labor, factory overhead budgets, selling and administrative expense budget, budgeted income statement. And then under these financial budgets, the cash budget, the capital expenditures budget, the budgeted balance sheet, budgeted retained earnings, budgeted cash flows. And again, and I'll mention this in when we're in class together, and then of course as we get closer and we do test review for the final exam. But we need to know there's a multiple choice question on the final exam that asks, kind of what is the starting point for in the budget process, and really, the first budget, the starting point, what we start with is the sales budget, right? Because every other budget is dependent on that sales budget in some way. And we'll kind of discuss that as we go through this. But, You know, if you think about our sales budget, well, the units that we expect to sell, that's what our materials, labor, and overheads based on, right? Because the more units we expect to sell, the more materials we need. The more units we expect to produce, the more labor we need. The more units we produce, the more overhead we're going to incur, right? So those budgets are based on sales. And then when we think about selling and administrative expenses budget, again, selling expenses usually encompass like the salesperson's salary or commissions. Commissions are generally based on sales, right? So again, that relates to the sales budget. Same thing, budgeted income statement relates to, well, what do we expect to come in revenue? That's our sales budget, how much we expect for, to earn in revenue. And then same thing with these financial budgets. So our cash budget, what we expect to have in cash receipts, cash disbursements, that's based on our sales budget. And again, some of these other things. So sales budget is generally the first budget, always prepared or usually prepared in this process. So we kind of see like this flow chart example of that here. Again, it starts with the sales budget, and then we can from there prepare our production budgets, selling administrative expense budget, cost of goods sold budget, budgeted income statement. So again, the starting point, generally sales budget. Okay, so here's an example of our sales budget. So it says the first step in preparing the master budget is the sales budget. And so to prepare this sales budget, we need the estimated unit sales, the estimated unit price, and we're just multiplying the two of them as we see here. So for example, in October, if we budget, 1,000 units, if we're selling each of them for $60 each, that's total budgeted sales dollars of 60,000, right? November, we expect 800 units. We're selling them at $60 each. That's budgeted sales dollars of 48,000. And here it's breaking it down per month. But then also it's given us the quarterly total. And so, if we're on a calendar year, this would be like fourth quarter, October, November, December, right? So it's given us our quarterly data as well. Okay, production budget. Production budget is where we're looking at how many units need to be produced. So we're looking at, okay, what is our beginning, what do we have to begin with? What do we expect to sell? What do we want to end with, right? So we kind of have to think about those components or those variables. So it starts with, okay, so if we say, because we don't want to completely sell out, we don't want to stock out as it's called, right? We don't want to completely sell out. So let's say we want to end with 100 units. So that's our budgeted ending inventory. However many units we want to end with, we take that, we add our budgeted sales, what we expect to sell that period, and then we're going to subtract what we started with, subtract any units we had to begin with. That's going to let us know how many units we need to produce. And again, the units that need to be produced is how we determine, well, what do we need for direct materials? What are we going to need for labor? How much is our overhead going to be type thing, right? So we see an example of that production budget here. Again, this one, when, especially when you're doing multiple months at a time or multiple months, right together like this, you have to consider, again, not only what are our sales for that month, right? What are our budgeted sales for that month? But what do we want to end with? Because we don't want to always, sell out. We want to have some safety stock, right? We want to have some safety stock. So we have to think about not only what we want to sell that period, that month, what we want to have left over, and then what we began with, right? And so if we have budgeted sales of 800, and then we want to end with 720, And then let's see. So next month's budgeted sales, 800. Ratio of inventory of future sales. So we want 90% to stay in our inventory. Okay. So budgeted ending inventory, 720. Plus we believe we're going to sell $1,000 or 1,000 units rather that month. So required units, 1720. And then we can subtract what we began with to get the number of units that we need to produce. And you see here, budgeted ending inventory in October is our beginning inventory for November, right? Budgeted ending inventory for November is our beginning inventory for December, right? Okay, direct materials budget. Again, direct materials budget's going to be based on how many units we need to produce. So if we go back here, we needed to produce what, 710 in October, 1340 November, 950 December. So now you'll see those numbers here, budgeted production for each month. So number 2, material requirements per unit. So in this case, remember we're producing hockey sticks. So each hockey stick requires 0.5 pound of wood. I think hockey sticks are still made out of wood. So each unit requires 0.5 pounds of wood. So if we take our 710 units times, 0.5 pounds per stick or per unit, we need to have 355 pounds of material. Again, just like with our production budget, we don't want to use all of our material. We want to have a little bit left over. We want to have some safety stock. So we want to add budgeted ending inventory. We want 335 pounds in ending inventory. So that gives us the total amount of units or pounds, the total amount of pounds that need to be purchased. And then we subtract, or the total amount of pounds that are required, I should say. And then we subtract what we began with to calculate what needs to be purchased. Once we know our material units that need to be purchased, then we can just multiply it by the price per pound or price per unit to get the total cost of direct materials. Again, the calculations aren't too bad here. It's just remembering that we have to consider what we want to end with, because we don't want to completely stock out. We want to have some in safety stock. So not only what we want to end with, but what we want to begin with, right? Direct labor budget, again, as you can see, direct labor budget is based on budgeted production. So we see those units here. And then we just multiply it by how long it takes to produce each unit. So the direct labor hours required per unit. And so remember, these are hockey sticks. So apparently it takes 0.25 or about 15 minutes. That'd be 0.25 of 1 hour, 25% of 1 hour. So about 15 minutes to produce a hockey stick. So if we want to produce 710 hockey sticks, they take about 15 minutes to produce. We're going to have to pay for a total of 177.5 direct labor hours. We pay these individuals an average of $12 per hour. So that gives us that total direct labor cost of $21.30. Again, not too bad on these calculations here. Selling expense budget, I mentioned earlier with the selling expense budget, generally speaking, the selling expense budget is made up of not only sales salaries, so like sales manager salaries or salespeople salaries, but also usually there's a variable commission, sales commission portion. So that's what we're looking at in this example. It says TSC pays sales commissions equal to 10% of total sales. TSC pays a monthly salary of $2,000 to its sales manager. And so we see that selling expense budget here. It's based on, again, budgeted sales. And then we multiply that by the sales commissions percentage, that gives us the total sales commissions. And that, again, that's the variable portion, right? Sales commission is the variable portion because it's based on a percentage of sales. So as sales go up or down, sales commissions go up or down, right? It's a variable cost. And then we add in any salary for our salespeople or for sales managers to get the total selling expenses. General and administrative expense budget. This one, pretty basic. Generally speaking, we'd have several rows here included on these general and administrative expenses, but they're just kind of giving us that one aggregate number for each month, and that's fine. So they're giving us the aggregate number for each month as well as the total for the quarter. Again, assuming this is a calendar year, this would be fourth quarter data, right? Okay, cash budgets, one or a couple things, I guess, really that we have to think about with these cash budgets is we have to think about not all customers pay in cash, right? Some customers use their store credit card, or some customers we have extended, in-house credit to. So not all customers, pay in cash. We have to consider that some of these might not be received, or that cash might not be received until the following month or the following accounting period. So we have to keep that in mind. But essentially, we're taking beginning cash balance plus any cash receipts or cash inflows minus any cash payments or cash outflows to determine what we think that we would have in there at the end of each month. And this allows us to determine if we are, basically going to have enough cash or if we're going to have a shortage, right? So in the case of if we have a shortage, we might investigate alternative financing options. In the case where we might have some excess, a good amount of excess cash, we might look at either, paying off a part of a loan or potentially taking advantage of an investment or something like that. All right, so on this example, it's going to show us, it says that for this company, 40% of sales are usually for cash. 60% of credit sales are not collected until the month following the sale, right? And so if we, again, based on that sales budget, if we think in October, we're going to have 60,000 in sales, but only 40% are for cash, 60% are on credit. So then we're going to take our 60,000 minus 60%, minus the credit sales people, right? So we take total sales minus the customers that pay on credit. That gives us cash sales. What's left over is cash sales, right? We take total sales minus the people that paid on credit. What's left over is the people that paid cash, right? So of this 60,000, we expect to collect 24,000 cash from customers. And then we're also going to add in any cash that is expected to be collected from the previous month of sales to get our total cash receipts for that month. And again, if we look here in October, 36,000 were represented, again, the customers that paid on credit. That's the amount we expect to collect in November, right? That's the collection from the prior month's receivables. And then we look here in November, 28,800 of those customers going to pay in November. So that's our collections for November. So, we have to kind of keep that in mind. And again, just like it said in the beginning of the PowerPoint, generally it's based on historical data or what happened in the past, right? And that's how we kind of set up our budget. All right, so here's an example of what that cash budget would look like. Again, we're taking beginning cash balance plus cash receipts, less any cash payments. And you can see where these cash payments are related to. So payments for direct materials came from that direct material budget. Payments for labor came from that direct labor budget. Payments for overhead from the overhead budget. payments on sales commissions from the sales commission budget, right? So on and so forth. So we see how those link to the master budget. And so then we can determine our preliminary or expected cash balance. And then from there, determine whether we have excess cash that can be used to pay down debt or take advantage of an investment, or if we need to look at alternative financing solutions. Maybe if we're going to have to take, a short-term loan or maybe issue some bonds or issue some stocks or things like that, right? So some decisions that we can look at by analyzing this cash budget. And so once we get through the master budget, the last part of this chapter talks about the flexible budget. And so remember, the master budget is considered a fixed budget, or what is also known as a static budget. Master budget's prepared, generally speaking, one level of activity, whereas the flexible budget is prepared after the fact based on what happened to compare our actual results to budgeted data. So then with our flexible budgets, it's more of an apples to apples comparison, right? Because if we sold 12,000 units, then we want to do a flexible budget for 12,000 units so we can compare apples to apples to apples, and then be looking, look at what actually happened compared to our budgeted data. We can calculate a variance or a difference between those results. All right, so to do that, and again, we're going to get practice with this in class together, but we have to kind of separate out the variable cost and the fixed cost. So first, we have to separate out the variable cost. We have to calculate a variable cost per unit, and then we have to separate out our fixed cost, the costs that do not change with different levels of activity. And so you see an example here of a flexible budget. Again, we have this flexible budget prepared for 10,000 units, for 12,000 units, for 14,000 units. The variable data is broken down per unit. And so once we have it in the per unit form, we're just multiplying by the number of units, right, to get the overall total for those levels of activity. Fixed costs remain the same at any level of activity. So you'll see those fixed costs are the same at all three levels of activity. So if we take our sales minus our variable cost, that gives us contribution margin. And then contribution margin minus fixed cost gives us that income from operations. So those budgets, are, whether we're discussing, the master budget components that are prepared before the start of the accounting period, or we're talking about these flexible budgets that maybe we prepared once the accounting period was over to compare the actual, to have that side by side, apple to apple comparison, right? These budgeted numbers or the budgeted data is based on standard cost. Standard cost are those costs that are preset cost for delivering a product or service under normal conditions. So we make or calculate a standard cost of direct materials per unit, a standard cost of direct labor per unit, a standard cost of overhead per unit, right? So we develop those standard costs. That's what we use to prepare our budgets, right? And so here we see this flexible budget performance report. In this flexible budget performance report, we're comparing what we budgeted. And so we see here's our budget, 12,000 units. We're comparing what we budgeted to what actually happened. Those are our actual results. And then from there, we can determine whether we are favorable or unfavorable. And that's what you see here on the side, the F's and the U's, right? Favorable or unfavorable. Okay, so I'm not going to read through every line of this. You guys can look at each individual line, but I want to point a few of these out to you. So for example, sales. This is our sales revenue, right? So we budgeted 120,000 in sales revenue. We actually had 125,000 in sales revenue. So that's 5,000 favorable. That's favorable because we are more than what we thought in revenue, right? This relates to sales revenue. We budgeted 120, we actually had 125. That is 5,000 favorable, right? Okay, but conversely now we look here at some of these costs. So direct materials, we budgeted 12,000. Actually, material cost was 13,000. So that's 1,000 unfavorable, right? We see that U. Direct labor, again, we budgeted 18,000. Direct labor was actually 20,000. So that one were 2,000 unfavorable. And what we'll see when we get into chapter 8, when we break this analysis, this variance analysis down a little bit more, what we'll see when we get into chapter 8 is that we can further analyze these variances, right? So if we're looking at materials variance, for example, we're 1,000 unfavorable. Okay, we can break this down into, were we unfavorable because we paid more per unit than what we thought, right? So were we unfavorable because it was a price variance? We paid more for the material than what we budgeted, than what we thought. Was it a price variance? Or are we 1,000 unfavorable from a quantity variance? We used more material than what we thought, right? We used up more material. So is it a quantity variance? And so same thing, like kind of with direct labor, you know, we look at this $2,000 unfavorable. Well, we can kind of drill down on this and we can break this down and we can determine, okay, is direct labor unfavorable because of a rate variance? Did we pay a direct labor rate of more than what we thought? In other words, if we budgeted direct labor cost of $15 per hour, but then we paid them 16 per hour, then that would be an unfavorable rate variance, right? So that's one way that labor could be unfavorable. Another way is efficiency variance. So, you know, we thought to produce 1,000 hockey sticks, it was going to take, you know, whatever, 500 hours. It actually took them 600 hours. So they weren't as efficient as we budgeted. So is it a rate variance? Did we pay them more than what we budgeted? Is it efficiency variance? Were they slower to produce the units than what we budgeted, type thing, right? So we can drill down on these variances as well. And we get more into that in chapter 8. All right, so the flexible budget preparation for factory overhead, just kind of something to keep in mind with factory overhead. We know that our factory overhead, there are some portions of factory overhead that are variable. There are some portions of factory overhead that are fixed. So we do need to know the difference between those two. Generally speaking, factory overhead is based on normal capacity, kind of standard production numbers, right? Is how we base our calculations. But just like it shows here, these calculations could also be based on theoretical capacity or practical capacity. You know, again, standard capacity is another kind of another way to say normal capacity, right? But theoretical capacity is the maximum number of units that can be produced with the completely efficient use of all available facilities and personnel. Practical capacity, the level of production that provides complete utilization of all facilities and personnel, but allows for some idle capacity due to operating interruptions like machine breakdowns or idle labor time, things like that. again, normal capacity, this is kind of the standard level of production that will meet the normal requirements of ordinary sales demand over a period of years. So a couple different ways that we can look at that when we're calculating these. Okay, here's some of the exercises that we're going to be looking at together. For your homework, you guys have, and I'm just flipping here. The exercises begin on page 398. And so for your homework, you guys are doing exercise 7.1, 7.3, and 7.6. So I think we're going to do 7.7, 7.8, 7.9, and then probably 7.2. We'll see how this ends up working out. I think what is most likely going to happen is we'll get through 7.7, 7.8, 7.9 in class. This problem 7-2 goes through several of the budgets. And so that might be one that I do an additional recorded lecture for, but we'll see how far we get with it in class. Okay. Hopefully that's making good sense to everybody. Hello again. All right. And so I will get this posted in OwlNet. And then we start chapter 7 together on Monday. And I look forward to going through and getting practice with some of these exercises with you guys. Bye-bye. Have a good day.